Ethereum. It's long been the butt of every joke in crypto. Every ETH holder has been waiting for the day that ETH finally pushes past $5,000 to a new all-time high. And let's just say, we're still waiting. But recently, ETH price has been showing signs of life once again. What's more, there's good reason for it. Once we scratch beneath the surface, we'll find a thriving ecosystem and demand that's greater than ever. So today we're showing you 5 reasons why Ethereum is still going strong and why the tide may finally be turning for ETH holders. My name is DC and you're watching the Coin Bureau. Now, the first reason why Ethereum ain't going nowhere is that it continues to be the chain of choice for developers and builders. According to the data from ChainSpect, Ethereum currently has just under 11,000 active developers, putting it in the #1 spot just above Solana. And just recently, a report by Electric Capital revealed that Ethereum had passed a milestone that no other blockchain has achieved: 1 million lifetime developers. And if that wasn't crazy enough, roughly 232,000 of those developers have been active over the last 12 months alone. The thing is though, looking at the amount of people building on Ethereum only tells part of the story. It's about what's being built there that really matters. And as it happens, Ethereum continues to be the weapon of choice for some of the biggest names in TradFi. If you've been keeping up with the crypto headlines, you'll know that Robinhood recently launched its own Ethereum Layer 2 blockchain, creatively named the Robinhood Chain. It was designed with DeFi and tokenized stocks in mind and has already seen hundreds of millions of dollars in daily volume and more than $250 million in total value locked. Not bad for a chain that's been around for less than a month. And of course, Robinhood is just the latest name to join the list of big names utilizing Ethereum's deep liquidity to launch their own tokenized assets. There is also JP Morgan, which has multiple money market funds on Ethereum. In December last year, it launched the My On-Chain Net Yield Fund, or MONey for short. The fund invests in US treasuries and repo agreements with a minimum investment of $1 million for qualified investors. Then in May this year, JP Morgan launched its second fund, the JP Morgan On-Chain Liquidity Token Money Market Fund, which thankfully used the ticker JLTXX. To keep things simple, you can think of JLTXX as money market fund similar to MONey, but available to more investors. Adding to the mix is Franklin Templeton's On-Chain Institutional Liquidity Fund. That's another money fund backed by government securities, cash and repo agreements, and currently has $1.6 billion in assets under management at the time of this shooting. And who could forget about the BlackRock USD Institutional Digital Liquidity Fund, or BIDL, which launched way back in March 2024 and is now the largest tokenized treasury fund in the world, with over $2.5 billion in assets under management. We could go on, but you get the picture. Ethereum is home to many of the biggest tokenized products in TradFi. And why? Well, because institutions generally prioritize security, predictability, liquidity, and proven infrastructure. Ethereum scores very highly across all these 4. That's why, as I record this, Ethereum dominates the landscape for tokenized real-world assets, or RWAs, with 44% of the market share. And this brings us to the second reason why Ethereum is stronger than its chart would have you believe, and that's the fact that it still dominates crypto capital. Not only does Ethereum dominate tokenized RWAs, but it's also home to just under 50% of the $300 billion plus stablecoin market. And this is a much bigger deal than you might think because stablecoins are the de facto cash of crypto. They're important for all kinds of use cases like trading, lending, payments, collateral, and even treasury management. The fact that billions of dollars in stablecoins live on Ethereum despite there being cheap alternatives out there shouldn't be taken for granted. Now, this relates to another area where Ethereum dominates in crypto capital, and that's total value locked, or TVL. As the second largest crypto by market cap, it's no surprise that Ethereum also has the highest TVL of any other smart contract blockchain at over $41 billion at the time of shooting. For perspective, the next biggest smart contract chain by TVL is Solana, with just $4.9 billion in TVL. In other words, Ethereum's DeFi TVL is 8 times higher than its biggest competitor. Even after the rise of chains like Solana, Tron, and BNB Chain, Ethereum remains the largest destination for deployed on-chain capital. Speaking of other blockchains, it's worth noting that the largest share of the crypto market either lives on Ethereum or one of its many Layer 2 chains. Networks like Base, Arbitrum, Optimism, and of course, the recently launched Robinhood chain inherit Ethereum security while dramatically increasing transaction throughput. Capital moving on these layer 2s generally stays within the Ethereum ecosystem rather than leaving it. ETH is also one of the most used crypto asset deposited as collateral across DeFi protocols, alongside Bitcoin's BTC. It's commonly used for borrowing stablecoins, derivatives margins, perpetual futures, lending markets, and of course, staking. BTC is arguably ETH's biggest rival when it comes to collateral quality, but ETH naturally plays a much larger role in DeFi due to its smart contract functionality. In any case, these factors collectively create a powerful flywheel that reinforces Ethereum's network effects. More capital attracts more developers build more applications attract more users deepen liquidity, deeper liquidity draws in institutions, which add further capital. And over the long run, this self-reinforcing loop makes it difficult for rivals to compete. But of course, that doesn't mean other crypto projects can't compete. Over the years, we've seen plenty of crypto projects launch with faster speeds and lower costs, all aiming to be the next Ethereum killer. Many of these perform well, but unless you're glued to a screen 16 hours a day like we are, it can be tough to keep up. That's why we built the Coin Bureau Club Lite plan right here on YouTube. Sign up and you'll get daily updates across both crypto and TradFi, our research team's take on the best opportunities, and curated insights with only the bits that truly matter. All for just $10 a month. Just tap the join button below this video to get started. The third reason why Ethereum should stay on your watch list is institutional demand. Put simply, institutional investors are able to invest in ETH much easier than ever, gaining exposure through spot Ethereum ETFs, treasury companies, and those tokenized funds I mentioned earlier. Now, for most of the first half of 2026, US spot Ethereum ETFs were bleeding money. 8 straight weeks of net outflows stretched through May and June as rising treasury yields and a more hawkish Federal Reserve pushed investors away from anything considered high risk. But that streak officially broke in July. As I record this, net flows have been almost entirely green since, with over $300 million flowing in. Unsurprisingly, BlackRock's Ether dominated those inflows. As a fun fact, BlackRock's Ether pulled in over $45 million in a single day out of roughly $54 million in total. Put differently, BlackRock's ETF accounted for more than 80% of that day's demand. But why does this matter? Well, when the world's largest asset manager drives that much cash into an asset, it shows conviction, and other institutions follow suit. And even though spot Bitcoin ETFs are definitely more popular, Ethereum ETFs have an advantage: staking. Back in September last year, Rex and Osprey launched the first Ethereum staking ETF in the US, allowing investors to gain exposure to ETH while also distributing staking rewards back to shareholders. Since then, a few more Ethereum staking ETFs have launched, including 2 from Grayscale and another from BlackRock. These not only let institutions earn native staking rewards without running their own validators, but also turn ETH into a yield-bearing asset that generates rewards, even in drawdowns. Another driver of institutional capital has been Ethereum treasury companies, and the biggest by far is BitMine, with a stash of more than 5.5 million ETH at the time of shooting. Now, BitMine's long-term goal is to hold 5% of ETH's supply, and it's already 92% of the way there. But BitMine is just one of 67 Ethereum treasury companies, collectively holding over 8.2 million ETH on their balance sheets. That's more than 6.8% of Ethereum's total supply. And with another company already pending, it's safe to say that this list will grow much longer once the bull market returns and excitement picks back up again. And if all that wasn't enough to convince institutions, there's also organizations dedicated to driving Ethereum's adoption on Wall Street. The big name here is Etherealize, which was launched in January 2025. Now, Etherealize was co-founded by Vivek Raman, a billionaire TradFi investor, and Danny Ryan, a former key member of the Ethereum Foundation, before stepping away to co-found Etherealize. If Danny Ryan's name sounds familiar, it's because he was the lead developer who coordinated the merge, the biggest upgrade in Ethereum's history, which saw it transition from proof of work to proof of stake. Safe to say, he understands Ethereum's architecture well enough to explain it to anyone scratching their head in a suit and tie. Anyway, in early July this year, we saw the launch of Ethereum Institutional, an independent nonprofit that has a very similar goal, helping TradFi entities to understand and adopt Ethereum's tech. Oh, and Ethereum recently launched its own dedicated institutions page. That page explains what Ethereum is capable of and, more importantly, shows off the impressive metrics with a $sign attached. With this much institutional interest in Ethereum, even when retail investors are looking the other way, Just imagine how insane things will get when things really heat up. And well, this brings us to the fourth reason why Ethereum continues to turn heads, which is that ETH is a productive asset. Because Ethereum runs on proof of stake, you can generate a direct yield simply by staking it and helping secure the network. Currently, that reward is 2.65%. Granted, for a normal retail investor like you or me, this isn't exactly life-changing, but for Ethereum treasury companies with billions of dollars worth of ETH, these staking rewards alone can provide a very lucrative revenue stream. In fact, BitMine's recent filings confirm that the company made $45.7 million in quarterly revenue from staking rewards, making up 98% of its total. And remember, that's just for one quarter. According to Chairman Tom Lee, BitMine has projected to see annualized staking rewards of $284 million once all of the company's ETH is staked. It goes without saying that this figure is likely to be inaccurate due to ETH's price fluctuations, but still, that's a lot of money being generated for doing very little, in the grand scheme of things, of course. So when you take a second to compare the business models of Ethereum treasury companies with their Bitcoin counterparts, you notice one key difference. As you already know, BTC can't be staked, and there is no way to earn BTC as a reward, at least not natively. This means Bitcoin treasury companies can only make money if Bitcoin's price goes up or if they take on additional risk elsewhere. When that risk becomes too much, or BTC's price stagnates for an extended period, even the most die-hard Bitcoin maxis can be forced to sell some of their BTC. Not naming any names, of course. Sailor, Michael, Mr. Michael Saylor. The point is, this advantage is what makes Ethereum treasury companies so appealing to institutions. Sure, you could argue that Bitcoin's relative safety is why institutions are still so involved there. But show them a company with a balance sheet built around the idea that staked ETH behaves less like a speculative cryptocurrency and more like an income-producing asset similar to a bond or dividend-paying stock, and it's almost impossible for them to resist. And this brings us to the fifth reason why Ethereum is still so impressive, the technical upgrades it has on the horizon. Ethereum's next upgrade is called Glamsterdam, and it's scheduled for the second half of 2026. Not exactly specific, I know. There are rumors it'll be rolled out in August, but nothing's set in stone yet. But what is Glamsterdam? Well, you can think of it as Ethereum's attempt to tackle its biggest obstacle, making the network more scalable without sacrificing decentralization and security. And this is a big deal. So much so that many people are calling Glamsterdam Ethereum's biggest upgrade since the merge. Now, like previous hard fork upgrades, Glamsterdam will implement multiple Ethereum improvement proposals or EIPs simultaneously. Specifically, there are 10 EIPs, with 2 being the most exciting. The first is EIP 7732, which introduces Enshrined Proposer Building Separation, or EPBS for short. In a nutshell, EPBS is designed to make Ethereum's block building process more decentralized and transparent. Right now, many validators rely on external services called relays to connect with specialized block builders who optimize transactions and capture MEV. EPBS brings this process directly into Ethereum's protocol, removing the need for these middlemen and making block production more resistant to censorship and centralization. This creates a cleaner system where validators and builders each do their own job, with Ethereum itself handling the handoff and payments. The second headliner is EIP 7928, which introduces block-level access lists, or BALs for short. A lot of acronyms here, I know. Anyway, BALs will make transaction executions far more efficient. You see, today Ethereum runs transactions one by one because it doesn't know which bits of data each transaction needs ahead of time. BALs solve this by mapping out the accounts and data each block needs in advance, allowing multiple transactions to be processed in parallel. Think of it like moving from a one-lane road to a multi-lane highway. So more cars can reach their destination at the same time, and there is less congestion during busy times. By increasing the amount of data each block can handle and updating how gas fees are calculated, the upgrade will significantly reduce the cost of using Ethereum's Layer 1. For everyday users, that means paying less to send ETH, swap tokens, or interact with dApps. A welcome relief for many, I'm sure. Anyway, assuming Glamsterdam is implemented without a hitch, attention will turn to the next upgrade, Hegota, which is also expected in the second half of this year. Again, that's pretty vague, but it does imply that Hegota will roll out soon after Glamsterdam. The details of Hegota are still being discussed. So far, only one EIP has been confirmed. Another is being considered, and a whopping 26 EIPs have been put forward. For now, The only EIP scheduled for inclusion, assuming it doesn't get removed, is EIP 7805, also known as FOSSIL, which stands for Fork Choice Enforced Inclusion Lists. Basically, FOSSIL aims to make Ethereum more censorship resistant by ensuring valid transactions can't simply be ignored by block builders. It gives Ethereum a built-in safety net that helps keep block space open and fair, so no single group can quietly decide which transactions make it on-chain. Outside of FOSSIL, the main EIPs being discussed are centered around account abstraction and Merkle trees. For account abstraction, the idea is to introduce a transaction type that splits verification from execution. So this would enable flexible transaction signing, batch operations, the ability to pay transaction fees in stablecoins, and more. Merkle trees are a bit more complicated, but they're designed to make the network far more efficient. They replace the current Merkle Patricia trees with a new data structure, allowing validators to prove large amounts of data using much smaller cryptographic proofs. In practice, this means nodes need to store less data, blocks become more efficient to verify, and running a validator becomes much less demanding. Over time, Merkle trees make Ethereum more scalable and decentralized by lowering the hardware requirements needed to participate. Okay, I know that was a lot to digest, but the key takeaway is that these upgrades will scale Ethereum at the base layer. This means cheaper, faster transactions, all without sacrificing the decentralization and security that makes institutions comfortable parking billions and billions of dollars on the network in the first place. All right, after all that, I know what you're thinking. What does this mean for Ethereum's price? Well, as I record this, ETH has spent the last 3 weeks moving up and to the right, pumping by around 23% along the way. The main question is just how high can it keep climbing? So perhaps a better way to measure ETH's potential is to compare it against its BTC pair. Now, for most of 2026, ETH has been in a brutal downtrend against Bitcoin. The ETH-BTC ratio fell to roughly 0.25 in early June, down more than 40% from its August 2025 peak. That underperformance is exactly why so many traders have written ETH off already. Since early June though, ETH has been climbing against BTC, moving up and to the right for over 40 days at the time of shooting. Now this suggests that the rotation out of BTC and into ETH could be underway, which is a very promising sign. It gets even more promising though when you slap on the 200-day moving average. As you can see, ETH-BTC is on the verge of breaking out to trade above that moving average, which is a big deal. Historically, when Ethereum convincingly breaks above the 200-day moving average, it tends to perform extremely well. Now, before you get too excited though, it's worth noting that there are a few indicators working against Ethereum as well. The RSI is a little on the high end, meaning ETH could be approaching overbought territory. The MACD suggests something similar, with the wave pattern looking like a move to the downside is more likely. Volume isn't exactly sky high either, suggesting the upward price action we're seeing right now isn't sustainable. Overall then, it's a pretty mixed bag. So let's switch from a 200-day moving average to a 200-week one instead to get a clearer picture. 200-week moving averages are often preferred by traders because it compiles almost 4 years worth of data. This is perfect for anyone who wants to zoom out and remove all the noise. The 200-week moving average currently sits around 0.04 at the time of shooting, and ETH would need to rally by around 36% to break above it. It's not impossible, but it's a big jump at this stage of the market cycle. Whether Glamsterdam is the catalyst that makes this happen remains to be seen, but we reckon there is a good chance. Now, we should also note that several market analysts have also chipped in with their own predictions. Standard Chartered thinks that ETH can hit $4,000 by year-end, driven by Ethereum's dominance in stablecoins and tokenized real-world assets. Conversely, Citi puts ETH at just $2,240 by the end of the year, citing US crypto legislation being slower than expected and zero expected ETF inflows. While none of us here have a crystal ball, the likely answer is that ETH finishes the year significantly higher than the sub $2,000 price we're seeing right now. As we looked at today, ETH has a ton going for it, and with a bit of good fortune, this might be just the beginning of a much bigger ETH rally. But what do you think? Is ETH going to the moon again, hopefully, or are we in for more disappointment? Let us know your thoughts in the comments below. And if you're wondering whether altcoins will ever recover, then check out our video right over here. Alternatively, if you want to learn more about what Ethereum is and how it works, you can find out by watching the video right here, or there. As always, thanks so much for watching, and I'll see you again very soon. This is DC, signing